Yeah, I'd like to welcome everybody, particularly on a day like today. I mean, the weather's horrible, and Andrew and myself, actually from Metrics, have got a few umbrellas out the back there. So if anybody who got wet on the way here, we've got some decent umbrellas that you can pick up on the way out if your umbrella got blown out or something. So, but yeah, thanks for that. Now, one more piece of housekeeping. Has anybody recently returned from Iran? Seriously, though, coronavirus is everybody's thinking about it. To me, though, look, the panic is worse than the pandemic, and the pandemic isn't great. It is the flu, but it's got a much higher fatality rate. But that fatality rate is very much for older people or people with problems. We've had 2 deaths in Australia. We don't want 2 deaths, but one was 78 and one was 95. So the statistics, we've been following this very closely, are that if you're under 50 and you're healthy, there's a very, very low probability of you being seriously affected. So it is the flu, it is a flu-like thing. Flu come and go, and there are vaccines on the way. So there are already 2 vaccines being developed in the world, one of them here in Australia from University of Queensland. They're currently being tested. So everything's happening faster, the spread's fast these days, but so is the response. We've also seen policy response. I'm happy to say we called this presentation lower for longer. We can now say it's probably even lower for longer because Australia's already cut its rates 25 basis points, the Fed cut by 50 basis points, and Bank of Canada overnight, if you hadn't heard, cut by 50 basis points. So we have concerted easing around the world, and we'll probably see more policy response, hopefully some fiscal response as well. So our headline name for this thing is still intact. It is still lower for longer. Got a number of things to go through today. So talk about why retirees are different. We manage money for retirees. We want an award for it. We'll look about investing in equities for both growth and income. People think about it for growth, but it's also for income and for growth in income. Bit of an update on Australian shares, including a little bit of a quick, our quick first summary of the Australian reporting season and potential for coronavirus impacts. And then lastly, looking at global shares and how you can get good income from global shares. So who is Plato? For those of you who don't know Plato, because there's a mixed audience here, and many of you are familiar with us, but some aren't. Plato was one of the first boutiques, in fact, the first new boutique from the Pinnacle Group. We were founded in 2006. We did have over $6 billion under management until the last week or so, but over $5 billion in assets under management. And we specialise in income investing, and indeed we won an award a number of years ago for retirement product innovation because, believe it or not, we still have one of the only funds in Australia which has been designed bottom up for retirees. And thankfully, they can continue to keep those franking credits because one of the differences of retirees is, in fact, that their tax rate. It's not all about me. You see me up here all the time. We've got a couple of the guys in the audience, but there are 11 in the team. We have 5 PhDs, highly qualified and highly experienced. I mean, I've been doing this sort of stuff for well over 20 years, but the average team experience is 18 years. So, there's a hell of a lot of experience, and, we've all been through the GFC, everyone in the team. And all of the senior guys have equity in the firm that aligns the interests with yourselves and your clients. And most of us are actually invested in the fund, even though none of us are yet retired. And you also get the benefits of the Pinnacle Group. There's a lot of the Pinnacle people here that Mark and Amelia and Ed and Simon and other people are here who can also help you out. So that's us. Why are retirees different? Because, most of us here in this audience, we're in the accumulation mode, saving up money, but when you retire and when you no longer get that monthly salary, you have to replace it. You live off the earnings from your investments. Our focus is delivering consistent and high levels of income, whether it be from global shares or Australian shares, but also focusing on the tax difference because tax-exempt investors, and so thankfully they still do get those refunds of franking credits, we manage from their tax perspective. Also, the other thing they're facing, or retirees are facing these days, is longevity risk. We are living longer, and the other problem is lower for longer. Interest rates are just getting smaller and smaller. And indeed, this slide is now out of date. This slide is to the end of December. This is the real earnings after allowing for headline inflation on $1 million. And this line here is 0. And in fact, I just updated this slide this morning because somebody said, what does it look like after the last 25 basis point cut? Well, it's another $2,500 lower. If you have your money in overnight cash or basically in 10-year government bonds these days, after inflation, your $1 million is worth $13,000 less at the end of the year. And that assumes you're a retiree that's not paying tax. If you pay tax, it's even worse. So if you're sitting in lazy cash or even a government bond, which is now 70-something basis points, you're actually losing about $13,000 after you take account of inflation. That ain't going to fund a decent retirement. You are going to run out. And yes, it's got worse. We have seen the first 25 basis point cut, and now people are wondering when the next one is because the Fed's already gone 50, Bank of Canada's gone 50. People are factoring in at least one more cut here in Australia, as well as potentially other factors. So it is just getting harder and harder. And, this is not new, but coronavirus has just reinforced that. The chance or the likelihood of a recession is certainly significantly higher now than it was 3 months ago, given coronavirus and bushfires. And that just means interest rates will be lower for longer. And longevity risk, the problem there is, particularly if you can't access the pension, if you have other assets, holiday homes that don't give you income, $1 million is probably not enough for retirees if they are investing in safe assets. You probably know that, but you'll run out of money before you expect to die. But if you can lift up and go into a balance fund, and this is what you tell your clients, if you can increase that return to something like 3 or 4% real, you should be fine. We all know that, but it's a struggle telling clients, particularly when markets fall 10%. Thankfully, franking credits are still around, and I think this slide just highlights the importance of franking credits. You might think, it's only 1 or 2% a year. It's about 1.5%, 1.6% per year on the index. But if you compound that out over time, it makes a huge difference. So here's nearly 14 years. We're using the tax-exempt indices from S&P for the ASX 300. We're looking first at the price index in dark blue, the accumulation index, which just includes cash dividends in light blue, and then we look at their tax-exempt index, which includes cash dividends plus the franking credits. And over the last 14 and a half years, prices have gone up just under 3% per annum, which is not a lot. The accumulation index with cash dividends only has gone up 7.5% per annum. But if you add that inflation in, you're almost got to double digits. It's over 9%. And the beautiful power of compounding means that, in fact, the Australian equity market, after including franking credits, has gone up 250% over the last 14 and a half years, whereas the price index has only gone up 50%, just over 50%. So income is incredibly important in Australia, far less important in, say, the US. The other way that we look out for buybacks, and there's an interesting thing, those indices don't include buybacks. They don't include the franking credits in buybacks. They also don't include special dividends, which is interesting. And we are on the lookout for special dividends for our clients and buybacks, such as 2018, end of 2018, BHP's buyback, which was worth more than 20% for a tax-exempt investor like a retiree, because they fully value the franking, they get a full refund, and so they would have made more than 20% for every share they successfully tendered, or that we tendered on their behalf into the BHP buyback. So we look for these opportunities, and there are a few more around. Even this year, Qantas announced a small one in the latest reporting period, and there's some pretty good indications that CBA might be doing something mid-year when it sells some of its assets, because it's got the only bank that's really got excess capital. Mentioned before, we'll also quickly rerun some slides that, if you're familiar with our presentations, you will have seen this, but we update this every year, so it's got another year added to it, which is we're looking at, first slide here is looking at the available yields on the Australian market. And again, these are to the end of December, so take another 1/4 basis point off, 1/4% off the yields here on cash and bonds and term deposits. Australian equity market's been pretty consistent. That's the grey line, including gross dividends, around 6%. And the gap between the available yields on cash-like investments or safe investments and Australian equities grossed up for franking has never been bigger. The RBA is encouraging your clients, investors in general, to invest in riskier assets to get real earnings rather than having lazy cash, and they are being rewarded for that in terms of income. Obviously there is volatility along the way in terms of prices. This slide, however, doesn't give you a good picture of how you would have went if you'd invested there, and I also call this slide and the next two the history of my parents' retirement, because they retired in 1980 and really they had two things they invested in, cash or equities. So let's have a look at how my parents would have gone if they'd put $100,000, which is a fair bit of money back in 1980, either into shares or into cash. Now, the analysis that I'm doing is interesting because I'm doing it from my parents' perspective because they retired in 1980. What did they do? They lived off the income from their investments. So the way I've done this analysis is they live off the income, whatever they get from their shares or their cash, but they do not touch the capital. And that's what a lot of investors don't want to dig into the capital. So let's see how they went. Well, the black line or the dark blue line here is the interest that they would have got on their cash, 100,000 cash. And it was a pretty good time. You got double digit. You got more than $10,000 initially, 10 to 15 or more $1,000 in the 80s because interest rates were high. But now you're getting, quite frankly, bugger all. If you've been disciplined enough not to spend the 100,000 in cash. But here's an interesting one, and the maths are correct, but that light blue line, which now goes to over 70,000, is the income from an initial $100,000 Aussie equity portfolio, just an index fund. I've just used the index. I haven't picked CSL or the best stock in the index. This is just the index, the All Ords / spliced with the ASX 300. And when the franking credit index, it does include franking credits, and that's pretty tremendous. Chalk and cheese, 70,000 versus like 1,000. And some people say, how does that actually work? Well, I think the next slide puts it in perspective or makes you understand it, because the $100,000 initially for the share market is now about over $1.2 million. The Australian equity market over the last 40 years has gone up more than 12 times. So your initial 100,000 that you haven't touched and you haven't put any money back into it, it's just the capital per se has gone up 12 times. So you've now got a much bigger investment, and 6% of 1.2 million is 70 grand. So it makes sense. Of course, your 100,000 in cash is still 100,000 if you have had that discipline not to spend it. We've also done some other time periods, haven't got time to go through them, but they highlight some of the worst times to have invested in the share market, and you've still generally gone up. It also does highlight the volatility that, yes, share prices go down. The GFC highlights that. And we might have a down year this year if we have a recession or what have you. And we had a little bit of a down year around here, which is the recession we had to have, but that's pretty much faded away. But so there is volatility, and I'll go backwards, but you can also see that volatility in the dividends, but that is not nearly as big a fall in the GFC in dividends as there was in capital. Dividends tend to be more stable than the underlying capital. So to me, these slides together are great slides to show your clients to talk about the reason for investing in equities. Even if you're retired, and my parents or my mother was retired for not quite 40 years, but nearly 40 years, that's a long time. And anyone retiring today, there's an expectation you're probably going to live, or someone in a couple is going to live 30, 40 years. So you are investing for the longer term. Yes, there's some ups and downs. These slides highlight the ups and downs, but they also highlight investing in equities, where you invest for growth in both capital and income. Quick update on how we get more income. Now, all those slides are on index. Index gets 6%. In Australia, we've been able, in our Australian Shares Income Fund, we have been able to generate over 9% gross income after fees, year in, year out, distributed to our clients. So that's a much higher level than the index, and that's after our fees. How do we do it? Well, the index pays a certain amount of dividends. If last year you owned the index, this would have been the dividends you got and by month. And basically, well, it's when they go X. This is plotted by the X date of stocks, but essentially that's when they go. Some go X in February, some go X in March, some go X in May and August and September and all across the year. That's an interesting one. I had a look at this slide yesterday and I almost thought, gee, we've stuffed this up because there's an interesting one here and it's a trick question. It's certainly an umbrella for anybody who can get this question, apart from Peter, because you know. Why does the index have, because the grey bits are franking and the blue bits are cash dividends. Why have we got a chart that says there were some franking credits in January last year and no cash dividends? And we haven't made a mistake. We've just taken it from the index, from S&P. Anybody going to hazard a guess? No, it wasn't a buyback. They don't even include buyback ones. Actually, it is a trick question, but S&P's methodology is they do not include special dividends as dividends. They include them as a return on equity, a return of capital, and BHP paid a very large special dividend in January last year, or when X. But S&P say, well, hang on, we've got to account for the franking credits in this franking credit index. So they accounted for the franking credits, but they didn't account for the massive cash, $7 billion cash dividend that BHP paid out. So it's a bit of a trick question. But anyway, that's the pattern. What we do is we actively try and get more of those dividends than the index by actively trading our portfolio. So we were overweight BHP to get more of that special dividend. We were overweight BHP again in February when it had its ordinary dividend. And we move in and out, and we were overweight CommBank last year, and then we moved to other stocks later in the year. So we trade between these dates to get more of each one of these dividends and then more of that one. And by actively trading our portfolio, we capture more income and more franking credits. But the beauty of this strategy is we don't have to be overweight all the banks all the time to get more income. We can move in and out between the banks. So we're not overweight banks. And that's a good decision for the last few years because banks have had some pretty ordinary performance. So we haven't been hit like many income providers or funds that are overweight banks for much of the year. And the beauty of this strategy is really, I think, in this next slide, a little bit hard to understand, but just think about it. It is relative performance. So performance relative to the index over time, but as you move into this line 0 here is the ex-dividend date of a stock. So it looks at the performance of all dividend-paying stocks in the Australian market for basically 20 years and looks at how performance moves as one moves in towards the next dividend date. And because these lines are moving up, stocks in Australia that pay dividends have a tendency, not every one, but have a tendency on average to go up relative to other stocks before they go ex-dividend. And that's brilliant for our strategy because we want to buy the stocks to get their dividends. So we buy them here and they tend to go up and we get some outperformance and we capture the dividend. We hang it on till the X date. We get the dividend entitlement, the franking credit entitlement for our clients. Then we reevaluate and move into other stocks where we see other dividends. Or if we really like the stock, we stay there. And this is how we can get more income in the market without being overweight the banks and other high yielders. And it means we can still actually have CSL in our portfolio. So we rotate through stocks to capture the dividend and the franking and that tendency for stocks to run up. And that's how we get sustainably more income. But like all fund managers, we want to look at valuation of stocks. We look at how the quality of stocks. There's no point in buying horrible stocks. We want stocks with good business momentum. But I think a very important point, and we say this every time, is you also want to buy a stock that's going to pay a dividend. So just beware, and particularly, I think, in the environment we're moving into, with coronavirus and industries and stocks being affected, that many stocks might look attractive, but they may be dividend traps. You want to buy a stock for its income, but you want to make sure it's going to pay it, particularly if you buy it a couple of months before it announces its results. Because we don't want to buy AMP a year ago, and then it comes out and says we're going to cut the dividend, we're going to cut it again. And AMP, we've been using this for a while, but it's a classic case of a dividend trap because, very simple chart. Share price on this side in the grey line, and share price of AMP has largely fallen for the last couple of years. Apologies for anyone who works for AMP, particularly if you have shares in it. But funny enough, on this side we've got gross yield, and that's a dark line. And as the share price was falling heavily, particularly in 2018, the yield actually went up. And went up because what is dividend yield? Dividend yield is dividends paid over the last 12 months, usually defined as historic yield. Dividends paid last 12 months divided by current share price. So if the share price goes down, the yield goes up. Gee, that looks attractive. I could have bought AMP on 13 or 14 or 15% gross yield. Except that dividend cut, no dividends at all. And by the way, the share price has fallen. So classic dividend trap. It's not the only one. We could have used New Farm, we could have used Blackmores, could have used a number of stocks. Adelaide Brighton's been the same boat in that sort of thing. So beware the dividend trap. I mentioned before, we've been able to, since inception, deliver more than 9% gross income after fees. In fact, 7% cash yield, 2.7% franking credit yield. That is substantially more than the index's 1.5 franking yield. So you can see a lot more franking, but also a lot more cash dividend. Remember, that is after our fees. So we've been able to do that year in, year out. Just looking, and we can do touch a bit more of this in Q&A as well, but latest reporting season. Yeah, it wasn't great, wasn't fantastic, but it wasn't a complete disaster. There were some good results from the likes of JB Hi-Fi. Gee, they did the same thing last year and the year before. They actually have bucked the retail trend. Some good results from CSL and ResMed. Iron ore miners, we've been saying they've been very profitable, paying great dividends. They continue to do so, and iron ore price is still pretty high. CBA, solid result, not a great result, but they haven't cut their dividend, the only bank not to. And as I mentioned, they've got excess capital. The only bank have excess capital, so a pretty good result there. But there's some negatives, mentioned AMP, Blackmores, even before the effect of coronavirus. Blackmores had a horrible result and didn't pay a dividend, and they've also said, look, we probably won't make virtually any earnings this half year because Chinese tourists are not coming and they're not going home with a bag full of Blackmore vitamins. And that's a big selling thing for them. I mean, it's true, they make a fortune out of those. I mean, you go down to any of the tourist shops down the quay and they got half the shops full of vitamins and, you know, milk and A2 milk and things. So overall, the result, the dividend period was pretty flat, really. And in fact, I think the median's probably the best way of looking at it. The median dividend this year, this last half year, was the same as last. So pretty much dividends are about flat. If you exclude all the big specials that were paid last year, you could actually make a positive thing and say actually dividends went up a bit. But the reality is clients, you know, it's dividends in their hand they look at. So they're pretty flat based, you know, this year versus last year. And remember, that's just stocks that were reporting in the month of February. And in terms of outlook, yeah, Blackmores, Cochlear. You may not think, how's Cochlear affected by coronavirus? Well, about 20% of their sales are into China. If you have a cochlear implant, you have to have a major operation. They inject it, you know, insert it into your ear and blah, blah, blah. There are no elective surgeries pretty much happening in China this year because the hospitals are full with people with the virus. And if that spreads worldwide, that could impact their sales this year. But the virus is temporary, flu's temporary next year. People will still want to have those implants. There'll be some catch-up. Anything related to tourism is pretty obvious. Treasury wine's big market into China as well. So, you know, we know some of the obvious ones. So it is going to get tough, and avoiding the dividend traps is going to be even more important, I think, in the next 6 months. Which brings the question of diversification is one way that you can reduce your risk, whether it be from coronavirus or everything else. Make sure you have a well-diversified portfolio. Don't just have one or two income stocks. If you've been in the banks and Telstra the last couple of years, you will know, or your clients have individual holdings, they'll be feeling the pain because those stocks have underperformed the market big time. And Telstra, I mean, 3 of the 4 banks have cut their dividends by about 15%, or ANZ just by the franking level. Telstra has cut its dividends 48%. In fact, if you've seen this slide, and we do this every year, you might say, well, hang on, isn't Telstra one of the 6 biggest dividend payers in the Australian market? Well, it isn't anymore because it's cut its dividends so much that it's no longer in the top 6 dividend payers by dollar value. It's been overtaken by Rio. But it just highlights, that pie chart highlights the lack of diversification in Australia. It is now the case that 4 banks and 2 iron ore miners pay half the dividends in Australia. Now, we like the iron ore miners. The banks, not so much, but they're cheap, but they've obviously got some headwinds in terms of their earnings for the short term. This chart, I think, highlights why you need to be better diversified. So one, we hold a diversified portfolio of around 90 stocks in our income fund. We are not overweight the banks, and we're not, I don't think, currently overweight Telstra. So, but the other way of diversification is overseas diversification. Global shares, you get currency diversification, and our currency is declining. But also, look at that pie chart. The top 6 dividend payers globally represent less than 10% of global dividends. They are quite small. So even there, you can immediately see, yes, better diversification. And you probably can't read the names there, but you've got Exxon, you've got AT&T, you've got Apple and Microsoft are actually in the top 6 dividend payers, interestingly. Low yields, but they're big companies. There are 2 banks this year, HSBC and JP Morgan, although I feel that there will only be one next year because I have a feeling HSBC may not be in there next year, or this year. But much better diversification, and there's a few names on the right-hand side of stocks we've held in our portfolio. And indeed, we've been able to generate around 6%, just over 6% after fee income from our global shares portfolio. And you might think, well, how do you do that? That's pretty hard because global shares, they're not income related. Well, if you start looking for income, there's plenty. And indeed, we also do a summary every quarter of dividends. And last year, global shares increased their dividends by more than 10%, by actually 11% in Australian dollar terms, to over 2 trillion Australian dollars of dividends was paid globally. There's a lot of income from global shares, and it's growing. And there is a huge number of stocks globally paying dividends, far more, way more than we have in Australia. In fact, in January last year, when BHP, I think, was the only stock, and it was a special dividend, that paid a dividend to WNX in January last year, there are about 400 companies in other countries that paid dividends. So there's a lot more diversification. And indeed, March and September, you've got nearly 2,000 stocks paying dividends. So the world certainly is your oyster. It's our oyster in terms of the opportunities to receive dividends. And also, there is the same opportunity to capture that run-up, that tendency for dividend-paying stocks to outperform a little bit as they approach their ex-dividend period. And indeed, the red line, the black dotted line is Australia. The red line is German stocks. German stocks pay a single annual dividend, and they tend to have quite strong outperformance in that month or so, or 3 before they go ex-dividend. So that is how we've been able to generate consistent levels of high income from global shares. And the interesting thing is in our global shares income fund, which is a differentiation from our domestic one, is because we receive dividends and quite a lot of dividends each month, we actually pay out those dividends each month. And this chart here shows the monthly distributions. They are lumpy because some months have a lot more dividends than others. We just pay out what we've got. This chart, the light blue line is the yield of the index, and the dark blue line is our excess income above and beyond the index. And you can see we have substantially more income in each month, and we deliver it monthly. So for clients, many clients value getting income monthly. Our Australian fund doesn't distribute monthly, it distributes quarterly, but we do have a listed vehicle, some of you have probably invested in, or your clients, called PL8, or ticker PL8, Plato Income Maximiser, which also pays monthly dividends. So you can get that from our Australian opportunity as well as from the global. So just summing up, we didn't expect a coronavirus when we put this on and we picked the title of lower for longer, but it just reinforces that we believe, income from traditional sources is getting tougher and tougher to get, and so it is certainly a case of interest rates being lower for longer. In fact, probably much lower than we thought. Hopefully, we've been able to show you that by investing in a diversified portfolio of equities, whether it be Australian equities or global equities, that you can get diversification as well as good income and some capital growth. And we have a consistent track record of delivering high yield for our investors. So that is all there is from me. We've got a couple of vehicles there I'll hand back to Mark.
Thanks, Don.